syllabus for Unit 1 is as follows: issue of shares at par, at premium and at discount, forfeiture of shares, reissue, surrender of shares, rights issue and underwriting of shares. The books for references are Reddy and Murthy, Corporate Accounting, Margam Publications, Chennai 2015. The learning objective of this session are to understand and gain knowledge on issue of shares, learn the accounting treatment if shares are issued at different circumstances like at par, at discount, at premium. So since we have discussed the syllabus and learning objective, let's move on to the main content.
So before we proceed with the corporate accounting issue of shares, we have to know the meaning of company. So let's see the definition of a company. A company is a voluntary association of persons formed for some common purpose with capital divisible into parts known as shares and with limited liability. So a company exists only in the eyes of the law, and it may also be described as an artificial person created by law having a perpetual succession and a common seal. Moving on to know what is shares. Share is nothing but the capital of the company which is divided into different units with a definite value called as shares. So holders of the shares are called as the shareholders or the members of the company. They are also termed as the owners of the company. Share capital constitutes the basis of the capital structure of a company. Ownership of a company is vested in its shareholders, and a share represents the extent of ownership or interest in the assets and profits of the company. In this sense, a share may be defined as one of the equal parts into which the capital of the company is divided, entitling the holder of the share to a proportion of the profits. Moving on to the kinds of shares, under the Companies Act 1956, a company may have two classes of shares. They are preference shares and equity shares. A preference shares is one which enjoys certain preferential rights. First, on preference shares, a fixed dividend is guaranteed before any payment of dividend is made in respect of equity shares. The second preference enjoyed by the preference shares is in respect of the return of capital in the event of winding up of the company. Preference shareholders are paid back their capital before any other classes of shareholders. The types of preference shares are: first one is cumulative preference shares. The preference shareholders are paid dividend at a fixed rate. But when dividend goes on accumulating, in case the dividend is not paid, the preference shares are said to be cumulative. In case the dividends in a particular year are not paid, they will be carried forward to the next year or subsequent years. Preference shares are always cumulative unless otherwise stated. Non-cumulative preference shares. Shares in respect of which dividends do not accumulate are called as non-cumulative preference shares. If the company does not declare dividend in any year, the non-cumulative preference shares holders' rights to dividend in respect of that year is lost forever. The next is redeemable preference shares. Money on these shares can be refunded on the expiry of a specified period if the company does not require funds or at the option of the company. Often the commitment is made by the company at the time of issue of these shares. The next type of preference shares is irredeemable preference shares. So this is exactly opposite of the redeemable preference shares. Here the money will not be refunded at the time of winding up also. The next type is participating preference shares. The articles of association may contain a provision to the effect that after dividend has been paid on the equity shares at a specified rate, the shareholders of the preference shares will have a right to participate in the remaining profits in addition to the ordinary preference dividend. So such shares are called as participating preference shares. So they will be having a hand over the other preference shareholders. The next type is non-participating preference shares. Here, the participating right is not given to these type of shareholders. The next is convertible preference shares. So under convertible preference shares, the preference shares can be converted into stock or equity after a certain period of time. But whereas in case of non-convertible preference shares, this option is not available to those shareholders. The next is equity shares. So equity shares are those which carry no special right in respect of the annual dividends and return of capital after the company goes into liquidation. The rates of dividend on such shares is not fixed. The dividend on equity shares is paid out of the residual profit left after paying interest on debentures and dividend on preference shares. Their value in the stock exchange fluctuates on the basis of the rate of dividends declared. These equity shareholders are paid back at the time of winding up of the company after all the debtors and preference shareholders have been paid in full and not at any time during its working life. So these equity shares are also called as ordinary shares, and these type of shareholders have the voting rights. The equity shares will get dividend and repayment of capital only after meeting the claims of preference shareholders. The next type of shares which has a differential right is called as deferred shares. So deferred share is a term which we have to know. So deferred shares are also known as founders shares or management shares. They are issued to the promoters and their friends at the time of formation of the company. Since we discussed about the different types of shares, let's move on to the issue of shares. So issue can be performed in two types, that is for immediate full consideration or for consideration receivable in installments or calls. The first one is issue of shares for immediate full consideration. In such type of issue, the full issue value is received at a time. The transaction is completed without the necessity of the further follow-up action in future. Consideration receivable can either of the following: non-cash consideration or cash consideration. First, let's discuss the non-cash consideration. So, non-cash consideration, a company may issue shares for consideration other than cash in three different situations. The first one is issue of shares for acquisition of assets, that is for acquiring assets. The second one is issue of shares to vendors of the business. The third one is issue of shares to promoters, etc., for the services rendered by them. So, in such cases, the journal entry would be asset account debtor to share capital account. The narration will be bean shares allotted for the purchase of assets. So the next one is cash consideration. So the companies may issue shares and receive the full amount of the issue in one lump sum. The issue may be at par or at premium or at discount. Let's see the meaning of par, premium and discount at later slides. The journal entry in that case would be bank account debtor to share capital account. The narration will be bean shares allotted. The next type is issue of shares for consideration receivable in installments termed as calls. So majority of issue of shares by public limited companies are made in this way. This method is more flexible and convenient. The prospective investors need not pay the full value of shares immediately. So they can apply for more shares than they can pay immediately for. They can keep their future cash inflows in mind while making such a decision. This enhances the public response to the issue. The company may also need the amount of the entire issue in short run. This method enables a company to make calls to the extent necessary immediately and postpone further calls to a convenient time in future. So, the procedure or the following is the usual procedure which has been followed. They are application, allotment, first call, second call, and the call goes on till the final call. The consideration of issue of shares by majority of the public limited companies are receivable in installments like this. The issue of shares at par. The shares are issued at par when they are issued at a price equal to the face value. Take for example, a share with a face value of rupees 10 is issued at rupees 10. So here we call it that the issue has been done at par. The accounting treatment on receipt of application money will be bank account debtor. Here we have to show the amount, number of application received into application money per share to share application account. The narration will be bean amount received on application for particular shares at rupees dash per share. For transfer of application money. So, the application money transfer, the journal entry would be share application account debtor to share capital account with the amount, number of shares allotted into application money per share to bank account with the amount, number of shares rejected into application money per share to share allotment account with the amount of excess application. The narration will be bean application money adjusted. The next, for the amount due on allotment, the journal entry will be share allotment account with the amount, number of shares allotted into allotment money per share to share capital account. The narration will be bean money received on particular shares transferred to capital. On receipt of allotment money, the journal entry will be bank account debtor to share allotment account. The narration will be been allotment money on particular shares at rupees dash per share received. The next, for the call amount due, the journal entry will be share call account data with the amount number of shares into call money per share to share capital account. The narration will be been call money due on particular shares at rupees dash per share. On receipt of call money, that is, when the call money is being received, the journal entry will be bank account data to share call account. The narration will be been call money received. The next is in the case of issue of shares at a premium. So, when the shares are being issued at a premium, it is issued at an amount more than the nominal or par value of the shares. Take for example, if the face value of the share is rupees 10 but the issue is being done at rupees 12, then it is said to be issue of shares at a premium. Premium is generally called with the amount due on allotment. So, a separate account is being created called as securities premium account where the amount of premium will be credited. So, it is being shown in the equity and liability side of the company's balance sheet under the head reserves and surplus. The journal entry when premium has been called up on application will be share application account debtor to share capital account to securities premium account. The narration will be in application money transferred to share capital and securities premium account. The next journal entry will be when premium has been called up on application, share allotment account data to share capital account to securities premium account. Being allotment money including premium made due. When the premium has been demanded along with the call money, the journal entry will be share call account debtor to share capital account to securities premium account. The narration will be call money including premium made due. Note, normally it is mentioned in the question as to when premium is receivable, on application or on allotment or on calls. In the absence of any information, it is assumed that the premium is due along with the allotment money. The next is issue of shares at a discount. When the issue price of the shares of the company are below their face value, it is an issue at discount. Issue of shares at a discount can be made only when the following provisions of the Section 79 of the Companies Act 1956 are satisfied. So, there are certain provisions under Section 79 to be fulfilled in order to issue shares at a discount. So, discount on issue of shares account will be created where this discount amount will be debited. The journal entry will be share allotment account debtor, discount on issue of shares account debtor to share capital account. The narration will be amount made due on allotment and adjusted discount. The next important concept we have to discuss is forfeiture of shares. Forfeiture of shares is nothing but the termination of the membership and taking away of the share of a shareholder because of default in payment of allotment and or call money. When the shares are forfeited, a shareholder ceases to be a member. His or her name is removed from the register of the member of the company. The forfeited shares become the property of the company. The amount already collected on them is a gain to the company. So, a shareholder fails to pay the called up money on allotment and further calls, his shares will automatically be forfeited. Shares can be cancelled and the amount already paid can be forfeited. The accounting treatment in case of forfeiture of shares which are issued at par is as follows. Share capital account debtor with the called up amount, to share forfeited account with the amount already received, to unpaid calls account with the amount due but not paid. When forfeiture of shares which are issued at premium, when premium amount has been received, the journal entry will be share capital account debtor with the amount called up less premium, to share forfeited account amount received so far, to unpaid call account amount not received. The next case will be when premium amount has not been received. In that case, the journal entry will be share capital account debtor with the amount called up less premium, securities premium account debtor, premium amount called up but not received, to share forfeited account amount received so far, to unpaid calls account amount not received. Forfeiture of shares which are issued at discount, the journal entry will be share capital account debtor called up amount, to discount on issue of shares account the original discount, to forfeited account amount actually received, To unpaid calls account, amount not received. Reissue of the forfeited shares. Forfeited shares can be issued at any rate of discount. The only condition is that the amount of the discount allowed on the reissue of the forfeited shares must not exceed the amount forfeited on such shares. The journal entry in case of reissue of shares will be bank account debtor with the amount received on reissue, shares forfeited account debtor, discount allowed on reissue, to share capital account with the amount credited as paid up. If the forfeited shares are reissued at a price higher than that of the paid up value, the excess of the reissue price over the paid up value should be credited to the securities premium account. The journal entry in that case will be bank account debtor to share capital account to securities premium account. Transfer of balance in the forfeited shares account. If after the reissue of all the shares there is still a balance left in the forfeited shares account, such a balance is capital profit, and therefore it is transferred to the capital reserve account. In that case, the journal entry will be shares forfeited account debtor to capital reserve account. So here is a sum for you all to try it out. Let me read out the question for you. Good Prospects Limited issued 40,000 shares of Rs 10 each at a premium of Rs 2 per share. The shares were payable as on application Rs 2 per share, on allotment Rs 5 per share including premium, on first and final call Rs 5 per share. All the shares were applied for and allotted. All money were received except the first and final call on 1000 shares which were forfeited. 400 of these shares were reissued as fully paid at Rs 8 per share. Give the necessary journal entries. So this is an easy sum which covers all the aspects we have studied now. That is issue, forfeiture and reissue. Please do give it a try. So here we have come to the summary of the session. We have studied about the meaning of the company, share and its kinds, issue of shares for immediate full consideration and consideration receivable in installments, accounting treatment of issue at par, premium and at discount, forfeiture of shares, reissue of forfeited shares.